If you turned 65 anytime in the last few years, there's a good chance you're still writing checks or letting auto pay quietly drain your account for bills the law never actually required you to pay in full again. Nobody at any of these agencies is going to call you and say, "Hey, you can stop now." That's not how the system works. The system bills you until you tell it to stop, and it keeps billing you at the full rate for the rest of your life if you never say a word. I want to be blunt about that right up front because it's the single most expensive misunderstanding I run into over and over in this line of work. Turning 65 doesn't just unlock Medicare. It quietly reclassifies you across dozens of federal, state, and local systems, tax authorities, utility regulators, motor vehicle departments, all of which are required by law to treat you differently from that point forward. Some bills shrink, some freeze, some disappear completely, but every single one of them requires you to raise your hand first. Before you decide this video isn't for you, let me shut down the two excuses I hear the most, because they're the exact reason people leave money on the table. Some of you are thinking, "I don't own a home, I don't have savings, none of this is for me." Wrong. Several of these apply whether you rent, whether you drive a 15-year-old sedan, whether your only income is a Social Security check. Others of you are thinking the opposite. "I did fine for myself. I've got a paid-off house and a decent pension. This list is for people who are struggling." Also wrong. A couple of these are worth more in raw dollars to the person who built up real assets than to anyone else on this list. I'll tell you exactly who benefits most from each one, so nobody watching gets to say that one's not for me. Quick word on who I am and why you should listen to any of this. My name is Ethan Brooks. I'm a state bar licensed elder law attorney, and for the better part of 2 decades I've sat across the table from assessors, Social Security field offices, DMV clerks, and state revenue departments on behalf of ordinary retirees. The pattern I see constantly isn't fraud. It's honest people who did everything right their whole working lives, quietly overpaying bills they were legally exempt from, simply because nobody ever sat them down and told them which box to check. That's the most expensive kind of mistake there is, because it's completely invisible. There's no late notice, no penalty letter, no alarm, just money leaving your account every single month that never had to leave at all. So today I'm walking you through 7 of these, one at a time, in plain English, with the exact thing you need to say or file for each one. Stay with me all the way to the end, because bill number 7 is the biggest dollar figure on this entire list by a wide margin, and it's also one of the easiest to claim if you know it exists. If you only act on one thing from this whole video, it's probably going to be that one. Number 1, federal income tax on your Social Security check. Let's start with the one almost everyone assumes is unavoidable, because for decades it basically was. Here's the part most people never learn. Social Security benefits are not automatically taxable. Whether the federal government taxes any of your check at all and how much of it depends entirely on something called your combined income, which is your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefit. If that combined number falls under a certain threshold, the IRS taxes exactly none of your Social Security, $0. For a single filer, that threshold sits at $25,000. For a married couple filing jointly, it's $32,000. Below those lines, your entire Social Security check is federal tax-free, full stop. Here's the catch that trips people up every year. A lot of retirees assume that because they receive a 1099 form referencing their Social Security income, that automatically means part of it is taxed. It doesn't. The form just reports what you received. Whether any of it actually gets taxed depends on that combined income calculation, and plenty of people who are perfectly comfortable modest pension, some IRA withdrawals, a bit of interest income still land under the threshold where a portion or even all of their benefit stays untaxed. There's also a second layer almost nobody talks about. Even above those thresholds, the government never taxes more than 85% of your Social Security benefit. No matter how much other income you have, that 15% floor is permanent. It's baked into the tax code and it applies to every single recipient, wealthy or not. Who benefits most here? Honestly, it's the person living primarily on Social Security with one modest secondary income source, a small pension, a part-time job, some interest from savings. That's the exact profile most likely to end entirely under the threshold and pay nothing at all on the benefit they worked their whole life to earn. The action here costs you nothing and takes about 10 minutes. When your return is prepared, ask specifically whether your preparer ran the combined income worksheet, not just plugged in a default percentage. If you file your own return through software, make sure your Social Security income is entered as its own line item so the program calculates the taxable portion correctly instead of assuming a flat rate. I'll add one more wrinkle here because it changes people's decisions more than they expect. If you're still working part-time or deciding whether to pull extra money out of an IRA in a given year, that decision doesn't just affect your regular tax bracket, it can also push more of your Social Security benefit into taxable territory. Since the combined income formula counts nearly every other dollar you bring in, two retirees with identical Social Security checks can end up with completely different taxable amounts depending on how they structure their other withdrawals. That's not a reason to avoid working or withdrawing, it's a reason to run the numbers before year-end instead of after, while you still have time to adjust. Number 2, state income tax on your retirement income. This is where the geography of your zip code quietly becomes one of the biggest financial decisions of your retirement, and most people never realize it. As of right now, a majority of states impose no state income tax on Social Security benefits at all, and a smaller but still substantial group goes further, exempting pension income, IRA withdrawals, and 401k distributions either partially or completely once you hit a certain age. Here's what surprises people. This isn't some obscure loophole for a handful of states. States like Pennsylvania, Mississippi, and Illinois exempt retirement account withdrawals and pension income almost entirely, regardless of how much you have. Other states, like Colorado and South Carolina, offer a substantial dollar exclusion on retirement income once you cross the age threshold, meaning the first several $1,000s of what you pull from your IRA every year simply isn't taxed by the state at all. The mistake I see constantly is retirees who move to a new state for the weather or to be near family. They just kept filing their taxes the same way they always had, never realizing their new state treats retirement income completely differently than the one they left, or worse, people who never checked at all and have been overpaying state tax on retirement withdrawals for years without anyone flagging it, because state tax software will happily calculate the wrong exemption if you don't manually confirm your age-based deductions are entered. Who does this help most? It depends entirely on your state, which is exactly the point you have to actually look this up rather than assume. But broadly speaking, it's enormous for anyone drawing meaningfully from a 401k or IRA, because unlike Social Security, that income has no federal floor protecting it. At the state level, the exemption can eliminate the tax completely. The action: pull up your specific state's Department of Revenue page for retirement income exclusion or pension exemption and confirm your age is correctly entered on your state return so the software applies it automatically. If you moved states in the last few years, this is worth checking immediately. It's one of the most common overlooked line items I see. There's a second layer to this worth mentioning, especially if you're still weighing where to retire or whether to relocate to be near grandchildren. Some states that do tax retirement income still carve out a specific dollar exclusion once you cross a certain age, meaning the first several $1,000s of your pension or IRA withdrawal isn't taxed even in a state that taxes the rest. That distinction matters enormously if you're comparing two states side by side, because this state taxes retirement income and this state taxes all of your retirement income are two very different sentences, and a lot of retirement planning articles online don't bother making the distinction. Number 3, your property tax bill. This is where the biggest dollar amounts on the entire list tend to hide, and it's not one form, it's usually 2 or 3, stacked on top of each other, and most homeowners have filed exactly none of them. Layer 1 is the basic homestead exemption, which shaves a chunk of your home's assessed value off the books before the county calculates what you owe. Layer 2, in most states that offer a homestead exemption, is a separate senior exemption that only kicks in the year you turn 65, and critically, it is almost never automatic. You have to file a second, entirely different application and ask for it by name. The third layer is the one that saves people the most money over time, without anyone ever pointing it out: the senior assessment freeze. Once you file it, the county locks in your home's taxable value at whatever it is the year you apply. From that point forward, no matter how much your neighborhood appreciates, your tax bill is calculated off that frozen number, not the current market value. Here's the part that trips up comfortable retirees specifically. A lot of people hear the word senior exemption and assume there's an income test they'll fail, so they never bother applying. In more than half the states that offer this benefit, there is no income test whatsoever. Age is the only qualification. You turn 65, you file the form, you get it whether you're living on a fixed income or sitting on a paid-off house worth triple what you bought it for. Who benefits most? The basic homestead exemption helps the lower-income homeowner the most in percentage terms, but the freeze specifically is worth a genuine fortune to the person whose home has appreciated significantly, because they're the ones staring down the largest future increases if that value stays unfrozen. And if you rent, this one still touches you. Your landlord pays that property tax bill and passes every dollar of an increase straight into your rent. When these exemptions and freezes are widely claimed across a community, it slows down how fast rents climb for everyone, including you. Make one call to fix this. Contact your county assessor's office directly and ask by name whether the homestead exemption, the senior exemption, and the assessment freeze are currently on file for your property. Don't assume, ask specifically. One more detail that catches families off guard, so I'll mention it here rather than let it slide by. In many counties, these exemptions and freezes have a hard filing deadline once a year, often in the spring, and missing it means paying the full bill for that entire tax year with no way to go back and fix it retroactively. It's not the end of the world if you miss it. You simply file next year, but it does mean the sooner you make that call, the sooner the clock starts working in your favor instead of against you. And if you're recently widowed, ask specifically whether these benefits transfer to a surviving spouse automatically in your county, because in a lot of places they don't, and families lose them by accident during an already difficult year. Number 4, your Medicare Part B premium. This one gets pulled directly out of your Social Security check before the money ever lands in your account, which is exactly why so many people forget they're even paying it every month. For 2026, the standard Part B premium runs a little over $200 a month. What almost nobody tells retirees is that there's a set of programs called Medicare savings programs, and if your income falls under the limit, your state will pay that premium for you outright, not reduce it. Pay it in full every single month. There are 3 tiers, and the most generous one doesn't stop at the premium. It also wipes out most of your deductibles and copays on top of it. Here's what genuinely bothers me about this benefit specifically. The income limits are far higher than most people assume. A lot of retirees hear the word assistance, assume they make too much, and never even check. And in a number of states, your savings and your paid-off house don't count against you at all, only your income does. Despite how generous this is, it remains one of the most underclaimed benefits in the entire system. Millions of people who currently qualify never apply, purely because nobody ever told them the program exists. Who does it help most? Anyone living primarily on Social Security. For that person, this single call can be worth more than almost anything else on this list on a monthly basis. The action is one phone call. Contact your local state health insurance assistance program office. It's free, staffed by trained counselors, and they will screen you for a Medicare savings program on the spot. While you have them on the phone, ask about a related program called Extra Help, sometimes known as the low-income subsidy, which dramatically lowers what you pay for prescription drugs under Medicare Part D in many cases. Qualifying for one enrolls you in the other automatically. A note on the asset question, because it's the single biggest reason people talk themselves out of calling. Historically, these programs looked at your savings and other resources, not just your income, which meant a modest nest egg could disqualify you even on a small fixed income. That's changed substantially in a number of states, where asset limits have either been raised dramatically or eliminated entirely. If you assumed years ago that you didn't qualify because of a savings account or a paid-off home, it's worth checking again now, because the rule you remember may no longer be the rule that applies. Number 5, vehicle registration, excise tax, and DMV fees. This one is smaller in dollar terms than the others, so I'm not going to oversell it, but it's still a bill you can legally stop carrying in full, and it adds up more than people expect once you actually look at it. In a substantial number of states, once you reach a certain age, your annual vehicle registration fee, your excise tax, or both, get reduced significantly or waived entirely. Some states also offer a permanent, no renewal required senior or disabled placard that eliminates sparking meter fees in certain zones and municipal lots. A few states go further and offer discounted or free public transit passes to anyone over 65, which matters even if you still drive, because it's one more bill quietly waiting to be claimed. Here's how I want you to think about this one. It's not going to change your life on its own, but it's one more recurring cost that the system already decided people in your situation shouldn't have to carry at full price, and it's there unclaimed for the exact same reason as everything else on this list. You only get it if you ask. So who actually benefits? Anyone still driving regularly, and especially anyone in a state where the reduction applies automatically at renewal once your date of birth is on file correctly, meaning the fix here can be as simple as confirming your information is accurate the next time you renew. The action: before your next registration renewal, call your state's Department of Motor Vehicles and ask directly whether a senior discount, fee waiver, or reduced excise rate applies to your age group and what you need to submit to claim it. While you're at it, it's worth asking two adjacent questions in the same call. Many municipalities offer a reduced rate or free senior transit pass that's separate from anything the DMV handles, and a number of utility companies, water, electric, sometimes even trash collection, run their own senior or fixed income discount programs that never get advertised beyond a small line on the back of a bill you've probably never read closely. None of these are individually life-changing. Stacked together over a year, they add up to a meaningful amount of money that was sitting there the entire time, waiting for someone to ask. Number 6, the federal estate tax. I want to address this one because a huge number of people assume it applies to them, panic a little, and either overpay for unnecessary estate planning services or avoid the topic entirely out of anxiety. Almost none of that anxiety is warranted. The federal estate tax only applies above an extremely high exemption threshold, one that sits in the tens of millions of dollars per individual, and roughly double that for a married couple. Once you account for portability between spouses, the overwhelming majority of estates in this country, including plenty of genuinely comfortable ones with paid-off homes, retirement accounts, and modest investment portfolios, fall nowhere near that line. Here's the part that surprises people the most. Most states have also fully repealed their own separate state-level estate or inheritance tax over the last 2 decades. Only a small handful still impose one, and even fewer apply it to a direct spouse or, in most cases, 2 children inheriting a modest estate. This means that for the vast majority of families watching this, the bill you've been quietly dreading, the idea that the government takes a large cut when you pass your home and savings to your kids, simply doesn't exist in the way you think it does. Who benefits most from knowing this? Genuinely, almost everyone with an estate under several $1 million, which is to say, nearly everyone watching. This isn't a benefit you file for. It's a fear you can let go of and redirect that planning energy towards something that actually matters, like making sure your beneficiary designations are current and your will reflects your actual wishes. The action here isn't a form, it's a phone call to an estate attorney or a review of your state's specific rules, just to confirm where your state currently stands, since the handful of states that still tax inheritances change their thresholds periodically. I'll mention one more concept while we're on this topic, because it comes up constantly in these conversations and causes unnecessary worry. Married couples benefit from something called portability, which allows a surviving spouse to use any unused portion of the first spouse's federal exemption in addition to their own, in practice. This means a couple's combined exemption is enormous. Locking it in requires filing a specific estate tax return after the first spouse passes, even if no tax is owed at that point. Skip that filing and you don't create a tax bill today, but you forfeit a valuable option down the road, one that's worth knowing about even if you never end up needing it. Number 7, capital gains tax on the sale of your home. This is the one I told you to stay for, because for the right person, it's worth more than every other item on this list combined, and it's also one of the easiest to claim, because in most cases, you don't have to file anything extra at all. It happens automatically the moment you sell, as long as you know the rule exists. Here's how it works. When you sell your primary home, the tax code lets you exclude a large chunk of the profit, the gain, not the sale price, from capital gains tax entirely. For a single filer, that exclusion is $250,000 of profit. For a married couple filing jointly, it's $500,000 of profit, not the sale price of the home, the profit, the amount your home appreciated above what you originally paid for it, plus qualifying improvements over the years. Think about what that actually means for someone who bought a modest home decades ago for a fraction of what it's worth today. If you bought your home for $80,000 in the 1980s and it's worth $580,000 today, your gain is roughly $500,000. As a married couple, that entire amount can come off tax-free, meaning you could sell that home and pay zero federal capital gains tax on the sale, despite the enormous appreciation. Here's the catch that trips people up. The exclusion requires that the home has been your primary residence for at least 2 of the last 5 years before the sale. It's not available on a second home, a rental property, or a home you've been out of 4 years while living elsewhere, unless specific exceptions apply. And if your gain exceeds the exclusion amount, which does happen in high appreciation markets, the excess above the limit is still taxable. So it's worth calculating your actual numbers before you list the house, not after. The person this helps most is unmistakable. The retiree sitting on a paid-off home that's appreciated significantly over the years, who's now considering downsizing, moving closer to family, or moving into a retirement community. This is precisely the group least likely to know the exclusion exists, because most of them haven't sold a home in 20 or 30 years and have no reason to have looked this up. Do this instead. If selling is even a possibility in the next few years, calculate your actual gain now. Take your original purchase price, add documented improvements, and subtract that total from current estimated value. That's where you stand relative to the exclusion before you're in the middle of a sale, not during it. If your numbers land close to the limit, timing the sale or documenting a few more improvements can make a real difference. 2 practical notes that save people real money on this one. First, start gathering your records now, not the week you list the house. Receipts for a new roof, a kitchen remodel, an addition, these all increase what's called your cost basis, which directly reduces your taxable gain, but only if you can document them. Old records have a way of disappearing over 30 years, so the sooner you start pulling them together, the better. Second, if you're a widow or widower and your spouse passed away recently, ask specifically about a rule that can step up your cost basis on the portion of the home your late spouse owned, which in some cases dramatically reduces or eliminates the gain altogether. It's a narrow window and an easy detail to miss during an already overwhelming time, which is exactly why it gets missed so often. Let me bring all of this back to a real person, because it's easy to hear 7-line items and lose the thread of what they actually add up to. I once worked with a man I'll call Walter, 74 years old, retired from a manufacturing job outside Pittsburgh, paid off home, modest pension, Social Security, some savings. When we sat down and went through his situation line by line, here's what we found. He was paying federal tax on his full Social Security benefit because his preparer had never run the combined income worksheet. He hadn't filed for his county's senior property tax exemption, despite qualifying for it for 9 straight years, and he was paying his full Medicare Part B premium every month, unaware that his income fell comfortably under the Medicare Savings Program threshold in his state. Nothing about Walter's life changed after we fixed this. He didn't move, he didn't sell anything, he didn't take on any risk. We filed a corrected federal return, a county exemption application, and a Medicare Savings Program screening. The only thing that changed was how much of his own money stayed in his account at the end of every month going forward for the rest of his life. He wasn't gaming the system. He wasn't getting away with anything he wasn't entitled to. He was simply, finally, claiming what the law had already promised him. What stuck with me about Walter's case wasn't the dollar figure, although it was significant. It was how long it had been sitting there unclaimed. 9 years of a property tax exemption he qualified for and never received. Years of a Medicare premium he didn't have to pay in full. None of it required a lawyer, a lawsuit, or a loophole. It required someone to sit down with him for an afternoon and ask the right questions out loud, one at a time. That's genuinely all this is. Not a trick, not a workaround, just questions that nobody had gotten around to asking him yet. That's the entire point of everything I've told you today. Being legally entitled to a benefit and actually receiving it are 2 completely different things. The only bridge between them is the form, and no agency is going to build that bridge for you. What to do this week? Here's exactly what I want you to do, and none of it costs you $1. First, when your tax return is prepared, confirm your preparer specifically ran the Social Security combined income worksheet and applied your state's retirement income exemption, rather than assuming a default calculation. Second, call your county assessor's office. Ask by name whether the homestead exemption, the senior exemption, and the assessment freeze are on file for your property, and if not, what Form adds each one. Third, call your local state health insurance assistance program office and ask to be screened for a Medicare savings program and extra help in the same call. Fourth, if a home sale is anywhere on your horizon, calculate your gain against the exclusion now, not later, and start gathering your improvement records while you can still find them. Fifth, if you're widowed or your spouse passed in the last few years, ask specifically about survivor transfers on your property tax exemptions and the step-up in basis on your home. Both windows are easy to miss during an already difficult stretch of life. None of these 5 calls require paperwork you don't already have. None of them require you to prove hardship or justify yourself to anyone. They're just questions asked by name to the office that already has the authority to answer them. And if the cost of paying someone to walk through all of this is part of why you've been putting it off, you don't have to pay anyone. Tax counseling for the elderly and AARP tax aid are both staffed by IRS certified volunteers who will sit down with you and file your return for free, and they know exactly which senior specific benefits to check for. For most of you, the cost of finally catching every one of these is nothing at all. One last thing, and it matters. This is general education, not personal legal or tax advice. These rules genuinely vary by state and by individual income, so always confirm your specific situation with your county, your state SHIP office, or a qualified professional before you act on anything here. And if any of this helped you, do one thing for me in return. Send this to one person you know who's over 65. It won't cost you anything, and it might put real money back into their pocket every single month for the rest of their life. I'll see you in the next one.